Defying the stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it out. Now is the time while you're waiting. You're not good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. And don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ stock update. Thank you for joining us today. We have a couple of really good stocks to talk about today. We have Cintas, which is a uniform company, and then we have Cognizant Technologies, which is an IT company. So let's get right to it and talk about these companies. The first one that we're going to talk about today is going to be, as we head on over here, we're going to look at the two of these stocks and how they ended up today. And most of them were about the same. If we look at Cintas was down just a little bit, and Cognizant Technologies was down about 1.23%. The market in general was up. And if you've listened to the news just a little bit, you know that the tech stocks, especially Tesla, who ended up the day 12%, is one of the biggest reasons why the overall NASDAQ was up for the day. And it continues to drive things for the entire year. If we look at everything together in the NASDAQ, let's look at it from the standpoint of the NASDAQ 100, because that's what we do in this live stream show, is we cover all of the stocks in the NASDAQ 100, two of them every single day. And the two that we're covering today, Cintas and Cognizant, let's look at how they compare to the overall NASDAQ 100. And if you follow the dancing cursor, of course, you can see what happened way back in February and March, which seems like a long time ago, but then maybe not far long enough. And then we follow it further up to today. We can see that the NASDAQ 100 obviously has been driven by the overwhelming technology stocks that are in that particular index. But it's really interesting because today we're talking about two different stocks. And yes, Cognizant Technologies is a tech stock, obviously. But Cintas is far from being a tech stock. Cintas is a uniform company, and a lot of the businesses that Cintas deals with is going to be the food industry, the regular manual labor industry, whatever the case is going to be from that standpoint. They have such a foothold that they have had extremely good competitiveness in the past year. And when you look at this in comparison to the other companies that they are in the same industry, you're going to see that they fare very well from that standpoint. We also want to compare the two stocks that we're talking about today to the S&P 500, because if you're retired, one of the best things that you can do is understand what you're putting your money into. I'm not encouraging you to be a speculator. I'm encouraging you to be an investor. And when you put money into investments as a retiree, you need to look at it from this standpoint. There are three reasons why people invest who are retired or who are close to retirement. Number one is going to be the growth. Obviously, you want to have growth of value, but some of you may be saying long-term for me is the life of a green banana. So it's not going to be a long-term from that standpoint. But if you're looking longer out there down the road and you've got maybe 20 or 30 years, and yes, if you are 60 and you're retiring, you should plan on having a long retirement of maybe 30 or 40 years. So if you use the strategy of bucketing, which I encourage you to do a lot, you go back over to my YouTube channel at Richard's Financial Planning, you can find an explanation of bucketing. But bucketing, this is the simple explanation of it. We take money and we put it into separate buckets, separate segments that are based on certain time periods. Let's say, for example, if you retire at the age of 62 or 65, and you have a bucket that's set up for 10 years. So you're going to go from age 65 to age 75, and this is the money that you're going to spend. Then when you look at it from the age 75 to 85, you have a bucket of money you're going to spend for that. And then over 80, you're going to have a bucket of money for that. So if you're at the age of 65, stay with me here. If you're at the age of 65 and you're retiring, you need to think of long-term as being 20 years down the road. So you're going to have a segment of money that you're putting there. So that's what stocks are for. If you are retiring and you're looking for income, dividends from stocks is going to be a significant benefit to you as well. Now, there's obviously some variability in there. And as I tell everybody all the time, the past performance of an investment is not a guarantee of what the future is going to be. So when we look at it from the standpoint of dividends, dividends can change. But that's why when you invest in NASDAQ stocks for dividends, you use a variety of stocks. You diversify just like you're buying the index, but you specialize and you weed out the stocks that don't pay dividends and you directly invest into the stocks that do. That's called direct indexing. And it's a specific technique that we utilize to create a portfolio that will pay dividends. Some people plow those dividends back in and let them reinvest. And there's some people out there that take the dividends for income. It's all up to you and how that you want to do it. So let's get back over to looking at the different stocks that we're talking about. And what I got onto this tangent about, the reason that I got onto this tangent was I was talking about the volatility. If you have an understanding of what the volatility is going to be like, that's the up and down movement of the stocks, it could help you to sleep a little bit better at night. Also, if you have an idea of how long that you should hold these stocks, that'll help you too. Remember, I'm encouraging you to be investors, not speculators. You're not looking at this as, I invested in Tesla this morning. Hey, I'm up 12%. That's not the whole idea of investing. That's speculating. If you're investing in Tesla and you're thinking that I'm going to keep this stock for a long time, and you just happen to be in it on a day when it split and it went up 12%, then good for you. But if you got in it and tried to time it, probability is it didn't work out that great. So anyhow, we want to compare things from a volatility standpoint to give you a little bit of an understanding of how things are going to work. So when you're retired or you're looking at your investments and you're thinking, okay, let's go back where the dancing cursor is here. And if you would have thought, well, should I get out of these stocks since the market's going down because of the coronavirus? Did some of you do that? Raise your hand if you did. Okay, I know some of you did. If you did you get back in at the right time? That's called speculating. Investing is something that is significant. Peter Lynch, who is one of the most significant and successful portfolio managers of all time, to paraphrase him, investing in stocks, it takes courage. You have to have the courage to stay in when everybody else is getting out. So if you stayed in, then you're an investor. You're not a speculator. And that's what this show is just for you. So I'm going to help you to understand how things will work. We want to look at the expectations of what might be happening with stocks as you go along. So we compare it to the S&P 500, and we use a statistic that's been up here on the screen that's called beta. The volatility of the S&P 500 is the beta, whereas the volatility of it is 1. It's just going to be the number 1. If you have a higher volatility experience, then you're going to have higher than 1. And a couple of stocks that we're going to be talking about today actually are more volatile. So it'll hopefully give you an expectation of what could be happening. And this is also very helpful if you're looking at it from the standpoint of when you should draw money out of an account. If you have if you have an investment with a high beta and you're thinking, I need to draw some money out of this for whatever reason, if you have a high beta stock, then it's probably not going to be good for trying to take money out sporadically, because it's a good possibility that it could be down in value right when you need to get money out. So investing in low beta stocks for withdrawing money is probably a good idea. High beta stocks, not so much. So let's keep going though. Okay, this is just a little explanation of what Cintas is, and it's a unique company in the spectrum of the NASDAQ 100, because you think of the NASDAQ 100 as all being stocks that are tech stocks. This is so far from being a tech stock. It is a uniform rental company. Now, they've gotten a little bit more diversification into facility services, and we're going to talk about that when we talk about the moat here in just a second. But when we look at some of the competitors of Cintas, we have UniFirst and Aramark. Aramark, a lot of you have probably heard of if you go to a ball game, or maybe you used to go to a ball game. When you went to a ball game, Aramark was one of the big companies that helps with the food services. Well, also the people that are wearing the uniforms are Aramark uniforms. They're a competitor with Cintas. There's another company that's called UniFirst. All three of these are publicly traded companies. Aramark's a little bit more diversified, and you can actually see if you follow the dancing cursor, Aramark had a little bit more difficulty right after the coronavirus market crash, and the biggest reason that they did is because of their food services that was related to sporting events. Nobody was going to sporting events, so they didn't need their services from that standpoint. They have not recovered to their pre-coronavirus market highs. But when you look at companies like Cintas, Cintas has recovered, and it's actually exceeded what its pre-coronavirus market highs were. We're going to talk about UniFirst here in just a little bit more in a second. But when we look at what went on, I want to show you just for a second, if I could. I want to zoom in here and look at what the earnings were, the earnings per share. The last earnings that are reported on this graph, the fourth quarter earnings event, there were nine analysts that projected that the earnings per share would be 123. The earnings per share were actually $1.35, which is actually 12 more cents than what they expected. So what we saw was we've seen this continue to grow and continue to go up. So it's actually been a good thing from that standpoint. Okay, when we talk about the beta, we're going to go back for just a minute. Remember, we were talking about the beta of these investments and comparing the volatility to the S&P 500. So what I threw up here on the screen is you'll see the orange line that's here, reddish orange, whatever you want to call it. The reddish orange line is going to be the S&P 500. And then you will see Cintas as the blue line. And you can see that obviously right after the coronavirus market crash back between February and March, that Cintas had a little bit of difficulty, a little bit more than the average S&P 500, regaining its steam and regaining its value from that standpoint, although they've continued to do that based on the fact that their earnings are doing pretty well. So when we look at the beta of this particular stock, this stock is actually more volatile than the S&P 500. So those of you that are out there and thinking, okay, I want to get a stock, or else I want to add stocks to my portfolio that are less volatile than the S&P 500 because I don't want the up and down that's going to go along with it, this might not be a stock for you because it's going to be more volatile from that standpoint. When we look at the earnings the price earnings ratio, it is at a 41.2. Now, what's that tell you? What that tells you is that it is higher than average. The earnings per share, in other words, the value over top of the earnings is higher than the average S&P 500 earnings. The price earnings ratio for the average stock in the S&P 500 is 30.14. So it's over about 11 points. So you'll see that that does have an effect. Sometimes you're also to give you a little bit of an understanding about the volatility of the stock. Again, if you're looking for a stock to add to your portfolio that's not as volatile as the general market, then this might not be the one for you. However, One of the best things about this stock is going to be coming up in just a moment. We'll talk about that here in just a second. Now, when we look at what the analysts are saying, it's a good thing to kind of take some of this information in, because the analysts obviously study this and they do a lot more research into the profitability of these stocks, and they look at where the profits are coming from the standpoint. When the analysts from Morningstar look at this, they look at it from the uniform standpoint, then they look at it from the business services standpoint. There are two other business services that are involved pretty much in Cintas, and it's going to be their first aid and safety division, and also their fire prevention, fire protection division. Those are not as established as the uniform division. The uniform division is really what's driving the value that's out there. Although if we look at it, remember the graphs from previously, you saw it going up pretty well. Well, that has a negative effect on it from a buying standpoint. Morningstar saying that the fair market value of this stock is $209 per share. It closed today over that quite a bit. It closed today at $333.24. Now, that's why Morningstar only gives that a 1 star. Now, remember, the star system is not like a star system for a restaurant. The star system primarily tells you, is this a good value or not? Is it a good buying opportunity or not? And what Morningstar's opinion is that this stock, although it is profitable, it might be overvalued and susceptible to a loss of steam from that standpoint of continued value. And you know, all of this is, you have to take it with a grain of salt, because I want you to remember something. When we're looking at these particular investments, look at it through market cycles. Now, I've mentioned this to you before, but market cycles are generally about 4 to 5 years. Down market cycles, which are going to be bear markets, generally last about an average of 18 months, except this most recent bear market, which only lasted about 3 months. The average bull market lasts between 3 to 4 years. Now, when you add all that up, it's going to be about 5 years as the average cycle. Now, if you can last through the cycle, then generally that's the optimal time period to take advantage of the profitability of stocks. So when we talk about long term, we're talking about going through cycles. And if you can last generally through at least 2 cycles, you're getting the optimal time period for investing. Okay, so let's keep moving on. Let's look at what the analysts out there are saying about Cintas. I know this is a little small, so let me help you out. It's a little small for me too. So let's look at it from the standpoint of what the average analysts are saying out there. Now, this is kind of like one of those TV commercials when you say 9 out of 10 dentists recommend Mighty Clean toothpaste. Well, the idea is here that the average analyst, when you're looking at this, they're looking at Cintas and saying, we're just holding on. We're not buying and we're not selling. 6 of the analysts that were polled were saying that they were just holding on. 2 of them were saying that it was going to be a moderate, a strong buy. 1 was moderate, and actually 1 was saying that they were ready to sell. So the average consensus among analysts is that this is going to be a stock that you would just hold on to. Now, I want to remind you of something, that these are not buy sell recommendations. I'm not telling you to run out and sell a stock or to run out and buy it. You need to look at it from your individual situation and see if it fits into your portfolio and your time frame for your particular situation. Okay, moving right along, we're going to talk about the moat of these different companies. Now, if you've never joined me before, this is what a moat is. The moat of a company is the sustainable profitability of that particular company. If you have a wide moat, then that means that you have a wide range for profitability. If you have a narrow moat, that means that the competitors are close to the gate. They're close to taking your lunch. So the idea is that that'll give you a little bit idea of this is an analyst view, of what the long-term profitability of these particular companies are. And it also gives you an idea that you should be more aware of these stocks in your portfolio. Now, those of you that are out there that are saying, I don't want to worry about this all the time. Well, this is the way that it generally works when I work with a client. We use a strategy that's called direct indexing. And let's say, for example, that you're a client and you decide that you want to invest in stocks. You like the idea of the growth, but you also would like to have some income. So what we do is we go to, let's say, the NASDAQ 100, and we would pick the stocks that are just paying dividends. Because remember, if you're looking for dividends, you want to get income. So we buy just those stocks, and then the income is paid directly to you. So you have some diversification of different industries. For example, if you had Cintas, obviously that's not a tech stock, but if you had Cognizant, which also pays a dividend, we'll talk about in just a minute, that is a tech stock. So you have some diversification of industries, and you also have a diversification of the stream of income that's utilized. Now, another big benefit of direct indexing is occurring right now. Now, what I mean by right now is you've probably heard that there are a few stocks in the Dow Jones Industrials that have gotten kicked out. ExxonMobil's one of them. And there are some companies that are entering in, like Salesforce. Those particular companies are disrupting how indexes are managed. And if you have an index fund that's based on the Dow Jones Industrials, it will affect you. Now, it could be a positive or it could be a negative. If you've held on to Exxon for a really long time and it's being taken out of the index, you possibly could have some tax implications, and they could be negative. Now, if you had a direct index, in other words, you own those stocks, and just because Apple decided to split and it revalued and shuffled everything that's going on, it affected the index. And some of you out there have to sell because of that particular shuffling. If you have a direct index, what I'm getting at is you don't have to sell. You sell when you want to sell. So if you wanted to maintain a position in ExxonMobil, even though that it's leaving the Dow Jones Industrials, then you could do that. You could own those 30 stocks. You continue to own it, and it would not impact your current income. Some of you, it will impact your income. So if you're interested in that strategy, you can contact me. Go to my website at richardsfinancialplanning.com. You'll find a place where you can find an opportunity to sign up to have a conversation with me, and we can talk about that. So let's get back over to talking about the moat of these particular companies. So when we're talking about Cintas, one of the big things that gives Cintas a wide moat is the fact that they control about 43% of the uniform market share. Yes, there are companies like UniFirst, and there are companies like Aramark that are competitors, but still the majority of the market is controlled by Cintas, and that's a big benefit, so it gives them a wide moat. When we look at the profitability of these different companies, let me run over here and get the right button to push. There are actually higher profit margins in Cintas than there are their competitors. When we compare, let's say we're going to compare UniFirst to Cintas and their profitability, you're going to see that Cintas has about a 5% higher profit margin. Now, when we're going to talk about the dividends here in just a minute, and that's going to make an impact on the dividends too, because if you have a higher profit margin, if you're a dividend paying company, that means you're paying more income to your shareholders. Now, a thin moat part, or I'll say narrow moat part of Cintas is their ancillary divisions. They also have divisions that offer business services, and those aren't quite developed yet. They're still in their infancy from that standpoint. They offer first aid and safety services. They also offer a fire protection services where they actually install fire detection services. Those are still in their infancy, and they don't compete quite as well with other companies that do the same thing. But they're in a good position from the standpoint of they can still continue to expand that with their other customer base. So overall, they're going to be a wide moat company. Their dividends are 0.76%. Now, that might not seem like a whole lot, but when you look at the profitability standpoint of growth and you add in the 0.76% dividend, that does make a difference. Now, a moment ago, when I talked about the higher margins, when you compare this to their closest competitors, which might be UniFirst, UniFirst only has a dividend of 0.51%. So when we're talking about that, Cintas has higher margins on their uniform services than UniFirst does, that's actually being reflected back in the dividends in itself, because UniFirst has a 0.51% dividend as compared to Cintas, which has 0.76. UniFirst is also a New York Stock Exchange fund, or not a fund, but a U.S. Let me get this out. It is a New York Stock Exchange stock as opposed to a NASDAQ Stock Exchange stock. Now, there's no real big difference in there other than that they are traded on different exchanges from this viewpoint. Okay, so moving right along, let's get into talking about Cognizant, because Cognizant is a very interesting company. They are an IT company. They're a global information technology service provider. They also have some new inroads into artificial intelligence, which we'll talk about just a little bit. They were down today about 1.31%. But one of the interesting things about Cognizant is, even though that their headquarters is in New Jersey, most of their employees are in India. So they are a global company from that standpoint. Now, this is a company that has a narrow moat. Now, the reason why we talk about, remember, we're talking about moats, is we're talking about this company's ability to stave off competitors, to do better than competitors in itself. This company does not have as wide of a moat in profitability and potential profitability as a company like Cintas. And one of the biggest reasons is that switching cost is involved in, if you are working with an IT company like Cognizant and you want to switch to another company like Accenture, that sometimes does the same thing. There's also another company called Optimum, which is a division of United Healthcare, that does a lot of the same things that Cognizant does. When you look at it from that standpoint, it's easier for these companies to switch. There's not as much switching cost involved. Now, that's something that you could look at it from a benefit, that it means that it's easier for people to understand or companies to work with, or not. But generally speaking, stickiness is a benefit. If you have a company, and we've talked about this with technology companies in the past, in past days, if you have a sticky company, that means that the people who are using their services will stick to it because it costs a lot of money to move on to another company. So if you don't have a large switching cost, which in comparison to its competitors like Accenture, the switching cost for Cognizant is not as high. So that gives them a narrow moat. One of the big things that they do have going for them is they do have a unique technical expertise in artificial intelligence. And that's something that actually is a benefit to them. And as time goes by, if they're able to capitalize on that, could increase their profitability over the long term. The thin diversification of industries, what that means is that they have Cognizant centralizes right now, their customer base is primarily in healthcare and financial services. If they are able to expand to other companies, as Accenture is possible able to do, then that would benefit them. That adds to the fact that their close competitors are able to take their lunch, so to speak. They're able to take their customers. So that means that the outlook for long-term profitability is not quite as high. When we compare the stock of Accenture to a company like Cognizant, if you follow the dancing cursor, you'll see that Accenture is in red and Cognizant is in blue. Okay, let's talk about the actual valuation of this. Now, it's interesting when we look at valuations, because if you think back a moment ago when we were talking about the value of a company like Cintas, you saw that the value of it was quite a bit over top of what the fair market value was that Morningstar was projecting for it. Now, that's not a benefit when you're looking at getting into the stock. So if you're looking at a stock that is closer to what its fair market value is, then Cognizant is that company. The fair market value pegged by Morningstar is $70, and today it closed at $66.80. So from that viewpoint, this company is a 3-star stock. Now, when we look at what other analysts are saying about this, let's zoom in just for a minute so we can see what they're saying. When we look at what other analysts are saying, you'll see that 10 of them are saying that this is going to be a hold. And actually, there are more analysts that are saying that this is a strong buy. And there's a couple of them that are going to be worrywarts that are saying that, no, you should sell. So take that information for what you will. Remember, this is not information that you want to use as buy-sell information. This is something that will help you to understand if you own this stock, if it's something that's going to fit into your long-term objectives, and if you are thinking of adding technology stocks like Cognizant, this will help you out to help you understand how the valuation works and how it would work into your particular portfolio. So moving right along, we want to look at what the beta is of Cognizant. Now, to do that, remember, we're going to compare it to the S&P 500. So if you follow the dancing cursor, you'll see that on the spaghetti graph, the orange or the reddish color is going to be the S&P 500, and you'll see that Cognizant is actually a little bit more volatile. When we look at the actual numbers, we can see that the beta is 1.20816. Now, what that means is that it's about 20%, about 1/5 more volatile than the S&P 500. When we look at the price to earnings ratio, this also reflects back to the 3-star rating that Morningstar gave the company, because they're looking at it from a profitability standpoint over top of what its earnings are. And its earnings are actually pretty good. When we compare it to other stocks that are in the S&P 500, remember when we talked about Cintas just a moment ago, we saw that the average PE ratio was about 30. So this is about 8 points, 9 points lower than that, and actually a good thing from that standpoint. So here's one of the bright spots, and that bright spot is this.
The beauty of your side.
Dividends are a wonderful thing, especially if you're retired and you're looking to create income. Cognizant pays a 1.3% dividend. So remember, how do we use that? So if you're using a direct index strategy, then you utilize it by investing in stocks that pay dividends. So if we're using it from the standpoint of, let's say, for example, we're looking at it and we're investing in the NASDAQ 100, and we just want to buy stocks in the NASDAQ 100 that are stocks that have dividends, then we would buy a stock like Cognizant. It pays a 1.3% dividend. You have the choice of either taking that in cash and being sent to you, or you can plow it back in to buy more shares. So it's up to you. But the idea of direct indexing is we just invest in stocks that pay dividends so that you can use that strategy either for current income, or remember, for long-term income if you're using that strategy we talked about just a moment ago, which was the bucketing system. All right. So we've gotten to the end of today, and I want to thank you for taking the time to visit with me and to watch. If you're watching this on a replay, remember that you can still enter your questions in. And as the week goes by, I'm glad to answer your questions. And I'll just encourage you to do 2 things here as we end up today. Number one, if you want to talk to me about your portfolio and about your retirement, then go to my website at Richard's Financial Planning, where we design financial plans that help people like you avoid running out of money during retirement. Go to the teal button, which says schedule a call to learn more, and you can sign up for a time to have a conversation with me. And then the other thing that I'll remind you about today is that stand by just for a moment, and you want to read the disclosure that is at the very end. And with that, I'm going to say have a great day, and we'll see you tomorrow.